Hello there everyone and welcome back to the Business English Podcast. I'm Ger, your CELTA qualified business English instructor. In today's episode, we've got a packed show. In the first segment, I'll take you through essential cryptocurrency terms, everything from Bitcoin and blockchain to smart contracts and stablecoins. We'll be breaking down each term with real-life examples and some insightful quotes from leading figures and reputable sources. In the second segment, we'll switch gears to business phrasal verbs, the kind you hear in meetings and emails. I had a comment from one of my student members on my channel membership asking me if I could cover more workplace phrasal verbs. Absolutely, and we'll do exactly that. So you're going to learn lots of new business English today. And if you are a student member on my channel, which is $4.99 a month, you'll get a complete glossary for this episode. All the terms are covered and listed. So if you're a member and you're listening, head over to the membership tab and download that now to really boost your comprehension around the topics we're going to discuss today. If this is your first time here with the channel, make sure to drop a like and subscribe. So let's get started with the broadest term that we have, cryptocurrency. Of course, cryptocurrency is kind of like digital money. According to Investopedia, a cryptocurrency is a digital or virtual currency secured by cryptography, which makes it nearly impossible to counterfeit or double spend. In plain English, crypto is money that only exists electronically, and it uses complex math to keep transactions secure. A big innovation is that most crypto is built on decentralized networks, meaning no single bank or government controls it. Instead, the network of users collectively verifies and records transactions on a blockchain. Don't worry, we'll define that in a little bit. You might ask, why do people trust digital currency? How is it different from normal money? This goes back to the fundamental idea that Satoshi Nakamoto, the mysterious creator of Bitcoin, pointed out. In 2009, he wrote, "The root problem with conventional currency is all the trust that's required to make it work." He was highlighting that traditional money relies on trusting banks and governments not to cheat or make mistakes. Cryptocurrency tries to fix this by making the system transparent and trustless. As he said, the central bank must be trusted not to debase the currency, but the history of fiat currencies, traditional currencies that is full of breaches of that trust. In short, crypto was invented to remove the need for a middleman. So the advantages of cryptocurrencies are big. Some people have pointed out that they allow cheaper and faster money transfers and create decentralized systems that do not collapse at a single point of failure. For example, you can send Bitcoin to a friend on the other side of the world in minutes without going through a bank. And because the system is decentralized, it can keep going even if some parts fail. There's no central server that can be crashed or attacked. On the other hand, there are downsides. Cryptocurrencies are very volatile. Their prices jump up and they jump down. Many investors saw this last year when Bitcoin lost about 2/3 of its value from its late 2021 peak. Situations like this make crypto very risky. Also, mining and transactions in some cryptos use a lot of electricity, and cryptos have been used in criminal activities due to their anonymous nature. As Investopedia warns, disadvantages include price volatility, high energy consumption for mining activities, and use in criminal activities. Now, here's a big word, Bitcoin. Think of Bitcoin as the granddaddy of cryptocurrencies. It was the first one that started it all. In 2008, an anonymous developer named Satoshi Nakamoto introduced Bitcoin. Bitcoin is defined as a cryptocurrency designed to act as money and a form of payment outside the control of any one person, group, or entity. In other words, Bitcoin was created to be like digital cash that you control yourself. No central bank or single company can decide its fate. Bitcoin is the most famous crypto, the one with the highest market value. It has become the most well-known and largest cryptocurrency in the world. Its protocol limits the total supply to 21 million coins, making it deflationary, like digital gold. People often compare Bitcoin to gold because it's scarce. As Satoshi envisioned, it's a way to send value peer-to-peer over the internet without a middleman. For example, if Alice in Spain wants to pay Bob in Brazil, she can send him bitcoins just like sending an email. No bank needed. But Bitcoin isn't perfect. First, it's extremely volatile. We already mentioned how far it fell in 2021. That kind of wild ride is a double-edged sword. It can attract investors hoping to get rich, but can also scare mainstream businesses and regulators. Secondly, Bitcoin's blockchain is relatively slow. It can handle only about 7 transactions per second. That's far fewer than, say, Visa's network, so fees can rise and confirmations can be slow when the network is busy. Third, mining Bitcoin, which we'll discuss in a bit, consumes a lot of electricity, so environmentalists worry about its carbon footprint. Lastly, because Bitcoin lets you send money pseudo-anonymously, it was famously used in illicit markets. Think the Silk Road case. Governments worry about this, so regulation is ramping up. The next term, which is important, is blockchain. You've already heard that word a lot. A blockchain is the technology that makes cryptocurrencies work. Simply put, a blockchain is a digital ledger, a list of transaction records that is distributed across many computers. Imagine it like a Google spreadsheet that anyone on the network can view and verify. Every time someone makes a transaction, say Alice pays Bob that 1 Bitcoin, it's recorded in a block. Each block links to the previous block by including a special code, a hash, of the previous block. Hence, the blocks form a chain. Now, the best way to think about this is to think of blockchain as a transparent train of information. Each car, or each block, has transaction data, and it's chained to the next car. Once a car is locked in, you can't go back and change it. The whole train would shift, so it's tamper evident. This creates trust without needing a boss or a bank. Everyone on the network has a copy of the entire train, so no one's user copy is tampered with. The others will reject it. Vitalik Buterin, the founder of Ethereum, another major crypto, put it nicely. Blockchain has the power to democratize access to financial services and empower the unbanked. He means that with blockchain, people who never had bank accounts can now participate in finance. For instance, getting loans or sending payments without a bank. In theory, blockchain could disrupt many industries by making processes open and trustless. An essential term in the subject of cryptocurrency is a cryptocurrency wallet. A wallet is where you keep your crypto, or at least the keys to your crypto. But what does that mean? A cryptocurrency wallet isn't like a physical wallet. It's software, or sometimes a hardware device, that holds your private keys. Each crypto address is like a bank account number, and the private key is the little secret PIN or password into it. Investopedia defines it simply. A cryptocurrency wallet is a device or program that stores your cryptocurrency keys and allows you to access your coins. Think of it like your email. Your email address is public and anyone can send mail to it, but you need your password to read it. In crypto, your public address is like the inbox address, and the private key is your password. If you have the private key, you can spend the coins in that address. There are different types of wallets. Software wallets, hardware wallets like a USB device, or paper wallets, the keys on paper. There are also custodial wallets where a company can hold the keys for you, and non-custodial where you hold your own keys. Custodial ones are like having a bank hold your cash. Non-custodial are like keeping the cash under your mattress. A term we've already heard is mining. Mining is how cryptocurrencies like Bitcoin keep the blockchain secure and generate new coins. It's a bit like a competitive puzzle solving contest. Let's stick with Bitcoin as an example. When you want to add a new block of transactions to Bitcoin's blockchain, you need to win a race. You need to solve a cryptographic puzzle. Investopedia calls Bitcoin's mining a network-wide competition to generate a cryptographic solution that matches specific criteria. In practice, computers, which are called miners here, run countless hash calculations per second, trying to find a number or a nonce that makes the block's hash meet a difficulty target. The first miner to do it yells, "I got it," and that block gets added. The winner earns a reward in newly minted Bitcoin plus any fees from the transactions in the block. You can imagine it like a lottery or a scavenger hunt. Every miner has to guess a number. The odds are slim for each try, but someone is guaranteed to find the solution roughly every 10 minutes. That's Bitcoin's target time. Because it's so random, miners often pool together so they have steadier incomes. The technical term for this is proof of work, or POW. Basically, the proof is that the miner did real expensive computational work. Energy and electricity were spent. This work is what secures the network. If someone tried to cheat by altering a block, they'd have to redo the proof of work for that block and all following blocks, which is practically impossible unless they own 51% of the network's computing power. This process is very tested and very secure, but the big drawback is energy consumption. Bitcoin mining alone uses as much electricity as some small countries, and this has raised environmental concerns. So let's move on to trading crypto. And if you want to trade crypto, you use a cryptocurrency exchange. This is a platform, like a stock market, that matches buyers and sellers. For example, to buy Bitcoin, you might use Coinbase, Binance, or Kraken. These are centralized exchanges, or CEXs. A company runs them, holds your funds in trust, and charges fees to match trades. Centralized exchanges are user-friendly. They offer an easy interface, customer support, and many coin choices. They also provide liquidity, meaning you can buy and sell quickly at competitive prices. For beginners and even pros, it's convenient to log in, deposit money, and buy crypto in one place. Here, though, you have to trust the exchange to hold your coins securely. History shows that this can be risky. In 2014, a Japanese exchange went bankrupt after losing hundreds of thousands of bitcoins in a hack. More recently, FTX collapsed in 2022 amid fraud and mismanagement, and many customers lost their funds. These events highlight that centralized exchanges, if poorly managed, can collapse at a single point of failure. And that's a real concern. This is why regulators are stepping in. The IMF and other bodies emphasize that crypto exchanges should be regulated like banks. In fact, an IMF policy paper recommends crypto asset service providers should be licensed, registered, and authorized, with rules like those governing providers of services in traditional financial sector. In simple terms, government want exchanges to be transparent and accountable, so customers have protection similar to a bank account. There are also decentralized exchanges, DEXs, which operate on blockchain protocols. On a DEX like Uniswap or PancakeSwap, there's no company controlling it. Trade happens directly between wallets, usually via smart contracts. The downside is DEXs can be confusing for new users, having less liquidity, especially for small coins, and there's still tech risk, bugs in smart contracts. Additionally, some DEXs have exploits and hacks too. Our next cryptocurrency term is altcoin. This is short for alternative coin, and it references any cryptocurrency other than Bitcoin. So Ethereum, Litecoin, Ripple, Dogecoin, and thousands of others are all altcoins. But they often share code and functionality with Bitcoin and each other. So why do these coins exist? Often developers create them to experiment with new ideas or to serve specific purposes. For example, Ethereum's altcoin Ether is built for running smart contracts and decentralized apps. Some altcoins try to make transactions faster, like Litecoin, or focus on privacy, like Monero. Others started as jokes or memes. Dogecoin began as a meme, though it now has a big following and even high-profile endorsements. A good way to think about it is if Bitcoin is Coca-Cola, the original cola, altcoins are all the other sodas and drinks on the shelf. Some, like Pepsi, a major altcoin, are big and well known. Others are niche flavors. Some might taste better for certain uses, but they might not always be available or safe. Consumers need to pick carefully and watch out for counterfeits. Let's move on to smart contract. A smart contract sounds technical, but it's actually a pretty neat concept. It's not a legal contract like you'd have with a lawyer. It's actually computer code on a blockchain that automatically enforces an agreement. A concise definition is, a smart contract is a self-executing program that automates the actions required in a blockchain transaction. Investopedia gives a great analogy. A smart contract is like a vending machine. When you insert the correct amount of money and push an item's button, the program or the machine dispenses your chosen item. In other words, you don't need a shopkeeper. The machine or smart contract takes your money and gives you the snack automatically. Similarly, a smart contract might say, if Alice sends 1 Ethereum to this contract, then we'll automatically send 100 of our tokens to Alice. No middleman is needed. It just happens when the conditions are met. Smart contracts allow trustless automation. Parties don't have to know or trust each other, and they don't need lawyers or banks to oversee it. They can drastically reduce paperwork and human error. But they're only as good as the code they're written with. If there's a bug in the smart contract, it can be a catastrophe. Another drawback is that complex legal terms don't translate into code easily. Smart contracts work best for simple, clear agreements. Our final cryptocurrency term for this episode is stablecoin. Stablecoins are cryptocurrencies designed to keep their value steady, unlike Bitcoin's roller coaster. The classic model is a coin pegged to a stable asset, often the US dollar. As one source puts it, a stablecoin is a blockchain token backed by a reserve quantity of another asset to attempt to stabilize its price. In practice, many stablecoins try to maintain a 1-to-1 ratio value with the US dollar. The original idea goes back to the gold standard, where currency was backed by gold reserves. Modern stablecoins often back themselves with dollars or equivalents. Stablecoins combine the decentralization of crypto with the stability of fiat money or traditional currencies. You get to use crypto rails without worrying about price swings. They are super useful for trading. Instead of cashing out to a bank, traders often move to stablecoins when they want to pause trading and avoid volatility. The catch is the backing asset. If a stablecoin claims to be backed by reserves, users need to trust that claim. Even with dollar-backed stablecoins, there are risks. Questions have been raised about some stablecoins' reserves and whether they really hold enough dollars. Regulators worry that stablecoins could impact financial stability if mishandled. So that covers our key crypto terms. Each of these have technical details, but I hope my examples and analogies have made them clearer. If you want to review these terms or share them with friends, remember my student membership includes a downloadable PDF glossary for this episode. It has all the definitions and examples we've covered. Access to the student membership is $4.99 a month, and it comes with lots of publications, guides, and exclusive videos, especially made for learners like you. Details are in the description below. So that was a deep dive into crypto. Now let's switch hats from finance guru back to your friendly English teacher. One of my long-standing student members, shout out to Jemima MPG 1564 for your great question and your continued support. I really appreciate it. You have asked me for phrasal verbs for work, so your request is my priority. Let's get to it. Phrasal verbs can be tricky for English learners, but learning them is super valuable because they make your speech sound more natural. These are verbs plus prepositions or adverbs, and their meanings often aren't obvious from the words alone. So here are 10 you should know. Our first is to follow up on something. This means to continue or check on something after an initial step. For example, suppose on Monday I ask you to email a supplier for information. On Tuesday, I might say, please follow up on that email if they haven't replied. You're essentially continuing the process. Another example would be, I just had a meeting with HR about my vacation days. I'll follow up on that to make sure they've approved my dates. Use follow up whenever you need to revisit something and ensure it's done. Our next phrasal verb is to take on something. This means to accept responsibility or to start doing something new. For example, can you take on the client presentation for next week? Here, a manager asks you to handle that task. It could also be used like, I've decided to take on more challenging projects to improve my skills. So take on is often used when a new job or responsibility is given or accepted. You might say, I'm happy to take on that extra work. A super positive phrasal verb for work is to step up or to step up to something. This phrasal verb is used when someone increases their efforts or takes initiative, often when there's a need. For example, if a project leader quits, someone might have to step up to lead the team. It's like being asked to rise to the occasion. You might hear, John stepped up and volunteered to organise the event after the coordinator resigned. Or, we need someone to step up and fix these issues. An essential phrasal verb for work is to carry out something. This means to perform or execute a task. For instance, an example sentence could be, our boss asked us to carry out a market analysis by Friday. Another example could be, we need to carry out this plan step by step, or the test was carried out successfully. Our fifth phrasal verb is to bring up something. This means to raise a topic or issue for discussion. In a meeting, you could say, I'd like to bring up the budget for next quarter. If you say this, you're introducing that topic. It could also be in conversation. He brought up an interesting point during the call. It's used for verbally mentioning something. If you have a question or concern, you bring it up to a group. Another example would be, don't be afraid to bring up your ideas in the meeting. Let's move on. Our sixth phrasal verb is to put forward. You would put forward an idea or a plan. Similar to bring up, but specifically means to propose or suggest something. For example, she put forward a new marketing strategy at the conference. That means she suggested it for others to consider. Another example, I'd like to put forward a solution to this problem. You can also say, put forward an argument in a debate. It's a bit more formal than bring up. We're barreling through these phrasal verbs. Number 7, to set up, like to set up a meeting, to set up an office, or to set up equipment. This means to arrange or establish something. It's common in business to say set up a meeting, set up an account, or set up a new office. For example, I'll set up a meeting with the design team for next Monday. Or, we need to set up the new office before May. It can also mean assembling or installing something. Please set up the projectors before the presentation. Think of it as arrange and prepare. Our eighth phrasal verb is to deal with something or someone. This is very common in work. It means to handle or manage something. An example would be, Can you deal with the client's complaint? It means you will take care of it. Or, I have to deal with a lot of emails every morning. You can deal with tasks, problem, people, or situations. It's often used when something might be challenging or requires attention. Our penultimate phrasal verb, to sort out a problem. This is similar to deal with, but often implies resolving confusion or organizing. For instance, let's sort out the schedule conflicts. This means we need to resolve which appointments overlap. He sorted out the billing issues after they got messy. It can also mean to simply organize or tidy up, like sorting out your paperwork. Our final phrasal verb, to call off. You would call off a meeting or an event. This means to cancel something that was planned. An example would be, due to bad weather, we had to call off the outdoor team building event. Or, the manager called off the meeting at the last minute. It implies you had something scheduled and then decided not to do it. Another variant would be to postpone, but call off usually means cancel entirely. So now I'm going to put them all together, all these 10 phrasal verbs, into one big paragraph. Okay, so get ready. We're going to use them all in a very natural scenario. Let's go. You're in a Monday morning meeting. The manager asks if you can take on the client report. You step up and volunteer. You tell him, sure, I can carry out that analysis. The manager then brings up a new idea and asks for suggestions. You put forward an idea about a marketing survey. Later, he wants you to set up a follow-up meeting. The client called complaining about an invoice, so your colleague needs to deal with that issue too. During the meeting, someone realizes two schedules clash. You remind them, we need to sort out this scheduling conflict. After discussion, the team decides to follow up on all action items after the call. Finally, if something goes wrong, say the CEO is sick, you might have to call off the executive meeting. Notice how smoothly these fit into business talk. Each verb is part of a common phrase. When you use them correctly, your English will sound much more natural. Before we wrap up, a few calls to action. If you've enjoyed this episode of the Business English Podcast, please subscribe to Learning English Pro. You'll get episode 9 coming next Monday, and I'm going to cover banking in English. Don't forget about the membership. For $4.99 a month, you get detailed glossary, PDF guides and exercises, and lots of other content for every new lesson and episode. For today's episode of the podcast, I prepared a lovely glossary full of all the terms we've covered today. It includes extra language tips and additional example sentences for each of the terms. Thanks for joining me on the Business English Podcast. I'm Jer. It's been great to have you here with me today. I hope this episode has helped you grow your business English vocabulary in the exciting world of cryptocurrency and everyday work life. See you next Monday.